All right. Well, you actually may know more CPAs than you do financial professionals, and in talking with CPAs, you'll probably notice that they're more interested in your past transactions than really what's going on in the future. They looked at those transactions to see what they should expect for a short time future. Well, finance is a little bit different. It's a subset of economics, and we're interested in only three things. And if you stick around, I'll tell you what those three things are. Sometimes known as financial engineers, real estate professionals. Yeah, we sit back and listen to us. We're kind of hard to listen to. Most of the time, we're also referred to as the physicist of business, and so you'll hear us talk about such things as Monte Carlo simulation, Black-Scholes, Black-Littman, real options analysis, Markowitz curves, and it'll give you a headache. But we're really, as advanced as all that stuff is, we're really only concerned about three things. And in this video, we're going to go talk about those three things. And now this video is a much smaller section of a much larger video. So it's just a snippet. I did it that way to make it more manageable for you. But if you look down in the description below, you'll see the links to the main video, the larger one, but also some of the little ones underneath it as well. All right, so I hope you like this video. If you do, give us a thumbs up. Please subscribe to the channel. We'd love to have you. Also hit that bell notification so as more videos come out, you'll get those. All right, our first slide up. One of the things we have to talk about is what's the nature of finance. So finance is really concerned with really three things. The first thing they're looking at is the magnitude of cash flow. It's always about cash flow. So in this case, magnitude of cash flow is whether it's positive cash flow or negative cash flow. The second thing that finance is interested in is the timing of those cash flows. You can get cash flow that comes too late, and it doesn't do you any good. Everybody knows that $1 too late doesn't do you any good. So the next thing they're looking at is the risk of cash flow. And what that means is, will the cash flow arrive in the manner in which you predicted it would be? All right. So one of the keys to creating income with investment property is using the proper vehicle to finance that property. Some of it's going to be equity and some of it's going to be debt. And we'll talk about the character of that. There's lots of different mortgage types that are out there, and we're not going to go into those tonight. I'm actually going to produce several videos where I'll feature each type, and so you can see how it can be used as a tool. And what you want to do is create a good income producing property based on a debt profile. And we'll talk about that a little bit more later. All right, so some of the key takeaways you should have gotten from that little segment that was in there is that finance professionals are really more interested in your magnitude of cash, timing of cash, and risk of cash. And as you didn't take long to figure out that, when it comes to magnitude of cash, well, we're interested in whether or not you're making money or losing money. Timing of cash, if you need money today and it's not coming in until tomorrow, that really didn't do you any good, right? And so the other part of it is the risk of cash. And the risk of cash determines whether or not we're going to see this cash at all. And so as a real estate professional, we are tasked to help maximize the cash flows of our clients. And that's what this movie was all about, or this video was all about. I hope you enjoyed. Like I said, look down in the description below and you'll see some more snippets of other videos that are down there, plus the larger video. On the end card, I'll also put a couple suggested videos for you as well. All right, thank you.